right, good morning, everyone. Good morning to everyone tuning in. Go ahead and drop a comment in the chat there for everybody jumping on. Good morning. We'll wait a few minutes to get started. Give everybody a chance to jump on. And wait for us to go live on all the different platforms. But feel free to drop a comment. If you're just tuning in. Happy Monday, everyone. Hope everyone had a great weekend. Once again, if you're just tuning in, we're just waiting a few minutes for everybody to jump on. Waiting a few minutes to go live on all the different platforms. Thank you, everybody, for tuning in on time. And we'll get started here shortly. All right. I think it's about time to get started here. So, welcome everyone. My name is Kyle Hiersche. I am the COO of the Mortgage Calculator. We are a correspondent lender that specializes in non-QM and investor loans. I am joined here today by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. And what we're going to do, like we do every morning, is go through the live rates today and actually pull up real rates for today for different loan scenarios. Then after that, we're going to jump into a deep dive into a special topic like we do every day. And today's special topic is going to be multifamily 2 to 4 unit properties. So right along with one of our specialties is working with investors. And this is going to be a great presentation here. So we'll have Jose dive into that a little deeper later. But for now, let's have Nick pull up all the rates for today for the different programs so we can check out how the rates have been. And we do this every morning so you can see how they go up and down and kind of track them there. So go ahead, Nick. Let's pull up our quoting tool and go through the rates.
All right. Thank you, sir. Let me go ahead and change my screen up and we'll get started. And let me pull up my pricing tool. All right, so just like we do every morning, we're going to go through our pricing tool. This is a tool for our mortgage professionals. We have over 350 loan officers. We're licensed in 22 different states for primary and second homes. And for our investor DSCR programs, business purpose loans, we can do those in most states. So please get with our team members if you'd like a full loan estimate. This is going to be our pricing tool to show us the general pricing with the general scenario just for today. And today is March 6th, just after 11 a.m. Eastern. So we have live rates on all of our regular programs. And thankfully, after a week of semi-bad news, it looks like the 10-year is down today. So we should have a little better rates today than we did on the last episode. So that's why we do the show. We love to watch it move. Let's set up our basic scenario like we do every day. We're going to do an 80% loan to value, 20% down payment. For all of our scenarios, we're going to set a $400,000 loan amount. Nice, easy loan amount. and desired price of 99. What that means is we're going to look for the best rate at one discount point in cost. That's because most of our customers in this market are asking to buy down the rate a little bit. And we're going to compare our different loan types. So just like we do every morning, we're going to do our first scenario as conforming conventional. Then we're going to go into usually our second option for most borrowers is our FHA options. Then we'll do our non-QM program. So at the Mortgage Calculator, as Kyle mentioned, we specialize in non-QM. Under expanded guidelines, we have over 4,500 loan programs that come up that allow us to qualify people beyond just the conventional and FHA programs. Of course, we have VA and USDA. VA is only for our eligible veterans, so we appreciate your service. If you'd like a quote and you are eligible for that program, we can quote it in just a few minutes. Please let us know. Same with USDA. Only properties that are in eligible areas can be quoted. So if you are looking in a specific area, please let us know. But since not everybody qualifies, we don't do that live every morning. Let's start with our conventional rates. We're going to set everything up as a purchase, 30-year fixed standard scenario, primary home, single family, 1 unit, Florida, Miami-Dade, 760 FICO for all of our scenarios today, estimated 40% debt to income ratio for all of our scenarios today. And we'll check out what our conventional rates are this morning. Let me get through the security check. And boom. Just as expected, the rates are a little bit lower than yesterday. So that's great. That's why we love to do this show. So it looks like there's a couple options up here. But if you notice down a little bit lower, there are some options for 6.875 rate for 0.875 in discount point cost. So that's better than it was last week. Last week we saw the rates go up to, I believe, 6.99 on, I think it was Thursday, and then Friday it actually went up over 7 on our standard scenarios here. So we love to see the markets go down a little bit. So please take advantage. If you're looking to lock that conventional loan, today looks like a great day to do so. Of course, there's going to be more economic announcements later, so we'll see these rates adjust over time. Now, let's go back into our pricing scenario and pull up our second scenario for today. We'll set everything the same. Do 80% loan to value, 20% down payment. And this time, typically if a customer doesn't qualify for conforming conventional, typically we're going to look at FHA next. So let's pull up our FHA rates. Everything else will stay the same. And let's see what FHA is looking like this morning. And it looks like we have some good options here. 6% rate, here's the second option for 0.75 in discount point cost. And please keep in mind that FHA does have the mortgage insurance, both annual, which is paid monthly, and the upfront. But we just updated our systems. All the loans coming out later this week, they will announce the new amounts, but those are programmed in here. So you see the APR is significantly lower than it was previously. That's because we have adjusted to the new announcements for the new MI factors. So that's pretty amazing. Obviously, always look at APR to compare apples to apples across programs. That way you can compare conventional to FHA and, of course, non-QM as we do some other scenarios here. So we love to see these things happen, and we love when the government announces things that allows borrowers to qualify for more home and saves borrowers money. So this is an amazing announcement. It is updated in our system. All of our programs are now eligible to use that new MI amount. Now, some customers still have trouble getting their home of their dreams under either conforming or FHA, and typically that's because full doc 2 years of tax return, especially for our self-employed borrowers, does present some challenges. So that's where our non-QM programs come in. So if for any reason a borrower can't qualify for what they're looking for conforming FHA, fortunately at the Mortgage Calculator, we have over 4,500 other options where other banks and lenders might not have any other options. So we'll check out our expanded guidelines non-QM. We'll keep everything else the same, but now you'll notice we have a new pop-up here for income verification. So we can choose full doc would be 2-year tax return. So typically that's not the reason we would go non-QM. Typically we're going to go to a non-QM program to use alternative documentation. 1-year alt doc, 2-year alt doc, asset related. We did a show on that last week. Please check that out. Business bank statement, 12 and 24 months are very popular. Investor DSCR for our investment properties. We'll go over that in a minute. And for today's show, our most popular program by far is going to be our personal bank statement, 12 months. And that's for our self-employed borrowers. As I mentioned many times, our self-employed borrowers have a hard time qualifying for as much as they want when they use their tax returns for various write-offs or other reasons. So we're going to use 12 bank statements to actually determine a debt-to-income ratio, in this case, a 40% debt-to-income ratio, using those actual bank statements to determine a cash actual debt to income ratio rather than relying on tax returns, which may have other write-offs and things like that. So we're going to look at their cash situation, determine their debt to income, and now we can qualify them typically where they wouldn't qualify before, or qualify a borrower for more home in that case. So let's check out our non-QM rates. And we love to offer these as alternatives. Obviously, we can quote all of our customers with all three options, but you'll see here we have some decent options for bank statements that are very comparable to conventional, especially when a customer may not otherwise qualify. So 7.625 rate, not that much different than conventional. That's what we love about the non-QM, very flexible, and 1 discount point in cost there. So pretty comparable, especially when you consider the borrower may not have otherwise qualified. If we cruise down here, there's just dozens of programs. There's probably a couple at better rate and combos. You see some down here for in the 7.375 range. So in the low sevens up to the eights, please get with our team. A lot of these programs with the higher rates that you'll see of these dozens of programs may allow things like credit events, like foreclosures, bankruptcies, things like that. And that's why we love non-QM as well, because it affords us flexibility, not only with the qualification of the income, but with other things as well. So we love to work those non-QM programs. Please get with our team since there's so many different options. We'll find the best option that fits for you. Now, before we pass it over to Jose for the detailed analysis, we always want to go into our live rates for investment properties as well. So we're going to switch this over to investment properties. We're going to pull up the same scenario, 80% loan to value, 20% down payment, same loan amount, same 1 discount point in cost. And we're going to compare our conforming conventional options for an investment property with our non-QM expanded guidelines options. Remember, FHA, VA, USDA are not eligible for investment properties, so we only have 2 options really to compare here. So let's first check out our conforming conventional. Everything else will stay the same as our scenarios today. And let's see what it looks like this morning. As I say every day, there has been some loan level price adjustments from Fannie Mae and Freddie Mac, the agencies that insure these loans and end up buying them. So unfortunately, we do not see any 1 discount point options under conventional. Even though some investors request us to go higher in the rate, you see here a 7.125 rate, which is great for an investment property, but 3.375 in discount point cost. So many times our investors are asking for alternative options to save discount points. And if you cruise down here on the sheet, some of our options do go up a little higher in rate, 7.49, a little bit lower discount points, but there's still nothing at 1 discount point in cost. So we would love to quote you guys these options if you qualify, but what really gets us excited is when we can compare these conforming investment property options with our non-QM options. So let's go over to that next. Excuse me. Go back to our pricer. Set up our final scenario for today. Same thing, 80% loan to value. This time we're going to do our expanded guidelines, investment property, and we have our 2 additional options that pop up. So first thing, we're going to select our income verification, and our most popular program by far for our investors is our DSCR program, and that's because it does not require any income verification from our borrowers. We simply use the property estimated rental income in order to determine typically if that covers the PITIA, the housing expense of the home that we're purchasing. And typically if the rents will cover the payment, that's a DSCR ratio of greater than 1. We have tons of options for those programs. And we even have options for properties that may not quite cash flow enough. So options for DSCR under 1. So tons of options here under the DSCR umbrella. That's really our most popular program because we actually don't need any income or employment information from the borrower. We just use the property. And the final option here is prepayment penalty for investment properties under non-QM. It's always standard to have a prepayment penalty. So we're going to use a standard 3-year. We can select 0. That's going to limit our loan options and obviously cost more. Or we can select 5 years, which will cost less. And again, a little bit less options. So the most common option is 3 years. So we'll use that for our scenario today. And let's check out our DSCR options. So some great options. Obviously, non-QM is obviously going to be a little bit higher in rate, but again, our investors are asking for that, right? They want to find a little bit higher rate as long as it cash flows in order to get less discount points. So you see the option up here. One of the best options the computer found was an 8.625 rate for 0.975 in discount point costs. So as long as this property will cash flow at that rate, many of our investors will take this option compared to a conforming option in order to save money out of pocket in discount points. So we love to give these options as comparable. I'm sure Jose will have a couple quotes pulled up to compare these as well for our multi-unit properties. But before we pass that over, just notice we have dozens of programs that differ in DSCR value, prepayment penalty amount. Some of these may allow short-term rental income, which may be a higher rate, but we can qualify them with short-term rental income. Just all kinds of different variations of our DSCR program. So please get with our team to find which one fits best for you. Here's one for the higher ratio. Anything greater than 1.4 means a high cash flowing property. We actually have an even better rate, 8.25 for 0.85 in discount point cost. So tons of options. Please get with our team. We really love these programs and we'd love to quote these for you. And we can do that in just a few minutes. So now let me introduce our topic for today, and I'll pass it over to Jose here in a second. Let me switch up the screens real quick, and we will get into it. Share. So if you're just joining us, our topic for today is going to be our multi-family 2 to 4 unit properties. So as many of you know, these do come with typically restrictions, especially under conventional. You saw in our demos, I did 1 unit properties. Keep it nice and simple, right? But for Jose's deep dive here, we're going to go into examples for 2, 3, and 4 unit properties, which are very common, especially when we deal with investors that are looking to increase their return on their investment properties. So multifamily properties are very common. We do have options as well for primary, right? For FHA purchases, right? To occupy it as primary 1 unit, use the rental income from other units. Lots of different variations to purchase multifamily properties. And especially as the rates have increased, a lot of our borrowers are looking for flexibility. Not only investors want flexibility to have more units, obviously it's kind of a no-brainer, but a lot of times our primary borrowers are looking for flexibility in order to qualify where they would not otherwise qualify. So let's go ahead and introduce Jose, our sales manager, 27 years in mortgage and real estate. So he wears 2 hats very often and has a lot of perspective on these kind of tricky situations. So Jose, why don't you go ahead and take over and talk about the ins and outs of 2 to 4 units.
Good morning, everybody. Thank you for joining us for Daily Mortgage Rates Live with the Mortgage Calculator. Jose Gonzalez here, sales manager. This is a very interesting topic for today, especially with purchases still being very active in the market. Obviously, hint, hint to those out there on our team. Be reaching out to all your realtor partners and share with them all the great tools and loan options that we have so that we can all collaborate and generate more business. So today's topic is super cool because it is the ultimate house hack, right? So today we're going to be going over a 4 unit. So we're just going to take it all the way to 4 units. We're going to bypass duplex, triplex, and go for the ultimate house hack for every investor that would love a 4 unit primary purchase. It always helps if this is your first purchase, makes it a lot easier and clean for the loan underwriting, because if your borrower has 3 or 4 other properties, including possibly a primary, it's gonna be nearly impossible to place them in a 4 unit property as their primary. However, if it is their first purchase, or if they approach you to get pre-approved for a first purchase that they already haven't thought of this themselves, you could suggest why not buy a 4 unit as a primary, right? So multiple ways to get this done, but obviously everyone's looking at the lowest down payment option. Lowest cost option is going to be an FHA primary 4-unit with only 3.5% down payment. Sounds almost too good to be true, but if properly structured, definitely doable. The one point that I do make when you are looking at a 4-unit property for an FHA loan is that please be aware that there will be a test completed on the income of the property to make sure that the property can sustain itself. In other words, you're going to get the market rent from all 4 units. And if the market rent covers the housing expense, you got a deal. If the market rent of all 4 units, remember, you're going to have 1 unit going to be occupied, but they're doing this hypothetical test of all 4 units being rented. So if the 4 units do cover the housing expense, you're good. If the 4 units rental income does not cover the housing expense, then you have to adjust either your loan amount, interest rate, or you have to make an adjustment. That is a very important point that most of the time slips right by the MLOs when they're structuring the deal. This is applicable to a 4-unit. So let's get right into it here in our first example, right? This is the one that has their mouth watering, right? 4-unit, right? Purchase, FHA, only 3.5% down payment, right? So you can buy the rate down all the way to 6.5%. Excuse me. Lowest cost option is 6.5% at a lender credit. There is a little bit of a lender credit there, $1,804 on our $723,750 loan on our $750,000 purchase. So only $26,250 down payment. You can buy the rate down all the way to 5.5% at a rate a little bit above 2 points. So 5.5% lowest rate option, 6.5% lowest cost option. So this is 4-unit property FHA and is definitely your best case. So now we're going to progress in what people would think would be the normal, I guess, progression of things, if I may sound a little redundant there. And let's look at a conventional 4-unit. But you will note that the conventional 4-unit primary purchase is not going to be your best option here as a secondary option, because conventional loans are very strict on 4-unit properties. So even if purchasing as a primary, if it is a 4-unit property, maximum LTV is 75%. So again, if your borrower is looking at this from a point of view of outlay, which most investors are, they're not necessarily looking just at the rate. They're looking at what is my capital outlay. And in this case, it's 25% down. Now, you do have good rates, right? I mean, 7.125 is the lowest cost option. No additional buy down fee there, no lender credit. And you could buy it down all the way to 6.25, roughly about 2.25 points on that one there. So interest rate wise, this is a great option, but 25% down as opposed to 15% down. So now we'll go to another full doc option, and here you can see the difference in the outlay. This one is full doc, 85% loan to value. So our loan to value increases here by 10%. So now loan amount $637,500. Yes, rates are a little bit higher, 9.625. Remember also, though, no mortgage insurance applicable here on our non-QM options. You would not be able to get mortgage insurance on a 3-unit or 4-unit primary purchase full doc anyhow. So here, 9.625 is your lowest cost option. and you can buy it down to 8.375 at a cost just under 3 points. So 8.375 to 9.625, 85% loan to value, right? So now look at this one very carefully, right? 9.625 to 8.375, because now I'm going to show you an 85% loan to value bank statement option. So not as many rate options, but still good options. You're looking at 9.5% as the lowest cost option to 9.125 as the lowest rate option. So if I go back to our full doc just to compare a minute, we had 9.5 was costing you $1,594. And here 9.5, 12,750. So it is a little bit more expensive going bank statement versus full doc. But again, this is using either business bank statements or personal bank statements as income for a self-employed borrower. No tax returns, nor tax transcripts, nor any of those items necessary. So now I want to show you the last option, which would be for an investment. But here we're going DSCR because we love our DSCR options. And I wanted to show everyone how the DSCR option is a very good option here at an 80% loan to value for a 4-unit property. Now, in our DSCR option, we are not using any of the borrower's personal income to qualify. We're only using the rental income generated by the property through a different number of manners, depending if it's from the lease, from a market rent, short-term rents, depending on the program that we are looking for. But we're looking here 80% loan to value with our lowest cost option 8.875 to our lowest rate option of 7.75%. So 80% loan to value, amazing options. This typically most of our investors, once they have these types of properties, have multiple properties. Most of the time, the simplest option for them is the DSCR option, but we obviously do offer them all the options available: bank statement, P&L, full doc, and then whichever is the best option for them or the one that's applicable for their income structure is the one that we choose. So at the Mortgage Calculator, we do have many, many options for our investors and our investment type properties, not just conventional, which would, conventional here, you'd be looking at 70 or 75% loan to value if you were doing this as an investment property and not a primary. So lots of great options for our house hacking. So please, team, reach out to your realtor partners out there and share the good news with them. And let's put some purchase deals together.
Thank you, sir. That was great. All right, let's talk about how to move forward, right? So we have over 350 loan officers all across the country. So maybe one of those loan officers shared this video with you. Get with them. They can send you these actual quotes. Just like Jose went over, you can get these actual quotes for your specific scenario. And they can do that with just in minutes, right? So get with one of our loan officers. If you are not speaking with one of our loan officers already, go ahead and visit us at themortgagecalculator.com, and we can hook you up with one of our loan officers who is a loan consultant. So notice all of these different programs that we have that Jose went through and even more. Our loan officers can walk you through these different options. So most loan officers and lenders only work with conventional FHA, USDA, but we take it a step further, and our loan officers can consult you through these thousands of non-QM options that we have to find the best fit for your situation. So get with us at themortgagecalculator.com. And we do this show every single weekday at 11 a.m. Eastern time, so you can see real rates, how they fluctuate day to day. And then we do a deep dive into a different topic every day, just like we did here today with the multifamily properties. So check us out every weekday, 11 a.m. Eastern. Thank you, Nick. Thank you, Jose. We appreciate everybody tuning in, and we will see you tomorrow. Take care, everyone.
Thank you, everybody.